Because I think one of the biggest impacts from this COVID situation was the overall availability of funding to start the business and to accelerate the business, to scale the business. So on our end, that was the immediate impact. We had to postpone the more capital-intensive projects and accelerated sort of a project where you can test quicker with less funding.
At the beginning, you just focus on cash flow. You know, once cash flow goes in, then you look at market opportunities. When market opportunities go in, you look at sales. So it really becomes this perfect triangle that everything has to be in balance. They'll come in to invest to get early, allocation into the company, but that doesn't mean that you have a partnership in place. And that's really, really important is, yeah, you've got in some of the big guys, but are you actually having them as a customer? Because if they're on the cap table to be on the cap table and they're maybe making an introduction, but you don't have them as a direct partner.
Okay, hi everyone. Thank you very much for joining tonight's panel. I'm very, very grateful to all the speakers who came to share their opinions about the current situation on the market and also to listen to our startups who will be pitching a very good group of startups that we selected especially for this event. So first I will start with presentation of Astra Global. Let me share the screen. So, one moment. So Astra Global is a global business development company that helps startups, investors, and corporates to meet each other. And we are doing this event together with our partners, Global Ventures Investments, and we will talk about our collaboration just in a sec. So what we do at Astra Global is we do warm introductions to venture capitalists of startups who are already ready and prepared for funding. And we know a lot of investors personally, and we can do a careful selection for startups of investors that are targeted and that are really suitable for them and save their time running around the market and trying to do cold calling and cold emailing people. And what we also can do is me having a 10 years background in M&A law, working for private equity companies, we can help startups to do deal structuring irrespective of the law applicable, despite I'm not a US lawyer or Swiss lawyer, etc., but I know the structures and I can basically advise on startups which clause is good for them, which clause is really bad for them, because startups, when they find money, they tend to be super happy and they tend to agree to everything, but this is not the right thing to do. You need to be careful with investors. The investors, I think you need to agree with that, not to lose your company and to have a good negotiations power. And I want to introduce Kobe Calderton from Gold Ventures, who is helping me with this event. Kobe, you can introduce yourself in our partnership. Thank you.
Thank you very much, Elena. My name is Kobe Calderon Jacob. Originally, I'm from Israel. My background is from the army. I served in the Israeli army 25 years, specialized cybersecurity, because I spent a lot of time in intelligence unit. I established a lot of IT companies in Israel. I'm part of groups of angels in Israel that include 522 members. We decided to open incubator in Israel, in Tel Aviv, because the ecosystem in Israel is very developed from the aspect of innovation entrepreneurship. We have a lot of capital, as you know. And we decided to open an incubator in Israel in order to help companies from the beginning, from the idea to global expansion, with a lot of consultants and mentors from US that lived in Israel. And after a very short time, after 3 years, actually now we are a global company that based in Tel Aviv and in Vienna. I moved from Israel to Europe. I'm living now in Austria. And we have partners in Brazil, in the United States, in California, in Europe, in 5 countries, especially in Poland, in Switzerland, in Germany, and Austria. And in Asia market, we have tight connections with Chinese investors in Shanghai, Beijing, and Shenzhen, Vietnam, and Australia. The main goal of GVI is to dive deeply to each company to see what is the potential that we can see in the company, not only from the aspect of technology and market. We try to analyze the skills and the execution skills of the founders. And based on that, we try to reduce the risk of the investors by matching our fund with foreign investors. This is what we have done in the Austrian market. Usually after a very short time, we bring a lot of companies from Israel to Austria in order to co-invest with groups of lenders in this place. So we reduce the risk by co-investing. And the second thing, we accelerate the companies. We build now global acceleration program in the countries in Europe in order to manage the projects and to give to all the startups the comprehensive solution that we can bring from our experience. And after the acceleration program, we help them to reach the potential corporate in order to make POCs, pilots, and to bring the product to the market in a very well-structured process. So in the end of the day, we are cooperate now with Astra Global, is our strategic partner, in order to team up together and to help the companies to grow in the global market. We can help you, the investors, to find the way how to cooperate with our investors. So in this way, you can reduce the risk. In the other end, we have a very good connections with grants from the EU. And especially now, in the coronavirus crisis, we have a lot of grants in Austria. So we can bring 80% of the money from Austria or from Poland, and we can match it with private fund that you can bring from your ventures. So I'm very, very grateful for this event. I'm very excited. This is my first time in this event. And I would like to let's go back to the panel.
Okay, thank you very much, Kobi. So now we will have the panel. You can see the panelists here. I'm doing the panel together with Anna. Anna, can you introduce yourself briefly? She's helping us with moderation of the panel.
Hello, everybody. My name is Anna Tutova. I'm CEO of Coins Telegram, and we are a PR consulting agency for tech companies. And we focus on fintech and blockchain companies, help companies to spread the word about the activity to attract users and investors. And we help with different publications in business media and financial media like Forbes, Bloomberg, TechCrunch, etc. As well, we help companies with entering new markets in Asia, Middle East, Europe, USA, and Latin America.
Okay, thank you very much, Anna. So first of all, I would like our panelists to have a chance to introduce themselves. Adrian, can you please say a couple of words about you and your fund?
Sure. My name is Adrian Mendoza. I'm the founder and general partner of Mendoza Ventures. We are a Boston-based early-stage fintech fund. Primarily, most of our portfolio is focused on fintech, AI, and cybersecurity. We are location agnostic, so our portfolio ranges from everywhere from Canada to the US to London, England. Even within the US, we have portfolio companies in Silicon Valley, New York, Boston, Austin, Texas, again, Toronto, London. So the goal is finding fintechs where we have deep expertise, where we could leverage our background and that of our LPs, which is a collection of senior executives at banks and insurance companies that really work with us to find the best of the best fintechs, AIs, and cybersecurity companies. So excited to join this. Interesting to see some of the European companies that are presenting today.
Great. Katya.
Hi, guys. Can you see me? Can you hear me? Anyway, nice to meet you. Hi. Yeah, it's, I couldn't join from my computer for some reason, but anyways, so we're based in New York. We invest in consumer companies, and we have quite unique revenue-based finance model. So other than revenue-based finance, we also provide working capital, and we have additional advisory help in terms of marketing and financial strategy to these companies. That's pretty much it. So we have basically investing. We started investing last year with the primary focus on non-cyclical consumer brands. And most of our LPs and investors are actually coming from Europe, so European family offices within consumer sector. That's pretty much where we are.
Great. Thank you, Katya. Xavier. Are you here, Xavier? Okay.
Oh, wow. I had to be the first to not unmute myself, so apologies for that. Xavier calling from Southern California, Tessera Venture Partners. We're kind of a stage agnostic investor in data. Specifically, we love the verticals of finance, healthcare, and media. And really along that, we strive to find companies that are doing exciting things in the world of data. And specifically, that's meant a lot of blockchain projects and artificial intelligence projects. And recently, our most recent investment was in Carta, kind of one of the latest fintech unicorns, and looking forward to chatting with my panelists and taking questions and seeing the startups present today.
Great, thank you. Elisabeth.
Hi everyone, Elisabeth here, calling out of Munich, Germany. We are a Series A B fund, Acton Capital. We do invest a little bit location agnostic, like Mendoza Ventures, in Europe, Canada, US East Coast, having some fintechs in the area of core banking platform, but also financial institutions in our portfolio. And yeah, very looking forward to the discussion and the panel today.
Thank you. Jean.
Hi, everyone. My name is Jin. I head the venture for Apis Partners, which is a venture and private equity firm based out of London. We focus on financial service and its adjacencies, such as healthcare and e-commerce. On the venture side, we run a managed account strategy where a lot of what you call the corporates outsource their corporate VC to us. So presently we're managing outsourced corporate VC for a top 3 US insurer. We work with banks and a lot of other strategics entering this space. And we invest globally with focus a lot on emerging markets.
Oh, great. Thank you. Boris.
Hello, everyone. So I'm the co-founder of ID Finance, based in Barcelona. We do digital finance in Europe and Latin America. So the last 2 markets we've entered are Mexico and Brazil, very exciting. And we offer consumer lending products across Mexico, Brazil, Spain, and looking to enter new markets in the next 12 or so months. Thank you.
Thank you. Gustav. Is Gustav here? Cannot see him. Jason.
Sure. Hi, everyone. It's Jason Miles. I'm the managing director and founder of VFS Innovation Ventures, which is the corporate venture arm of Volvo Financial Services. So Volvo Financial Services supports and is the captive finance company for Volvo Group. We lend to companies and customers that purchase Volvo products. But not cars. Cars are owned by a private equity firm now. We do everything across commercial vehicles, heavy duty vehicles, buses, and other large transport vehicles. We invest typically at the early stage, which I would call Series A and post Series C, Series Seed, and really look at companies that are in the fintech sector broadly defined. So, payments, insurtech, AI, big data, and things that are related to mobility services that kind of affect the vehicles that we produce. Elena, you're on mute now.
Thank you. Cyrus.
Hi guys, my name is Cyrus. I'm the founder and CEO of Swissborg. Essentially, we do crypto wealth management. 2-3 years ago, we did a big ICO around pretty much every country in the world. And our mission is really to bring Swiss wealth management to everyone by making it fair, fun, and meaningful.
Great, Swiss and fun, good combination. Okay, let's start the discussion, guys. So the general idea is to share the ideas, how do you actually adjust to the current situation in the market. So the first question is rethinking portfolio companies go-to-market strategy, or in case of companies, existing companies, you guys just share how do you change, if you change current go-to-market strategies, what you changed and what you didn't change. So I suggest you just start, whoever first.
Well, I think, in our group, in ID Finance, we incubate quite a lot of projects regularly. And because once we are present in one of the countries, we like to try different markets. And I think the biggest difference that we saw, and actually that they materialized, and we had to postpone some projects and accelerate the others. The projects which are less capital intensive, they would go first now. Because I think one of the biggest impacts from this COVID situation was the overall availability of funding to start the business and to accelerate the business, to scale the business. So on our end, that was the immediate impact. We had to postpone the more capital intensive projects and accelerated sort of a project where you can test quicker with less funding. That's on our side.
Yeah, on our side, being in the US, and especially we're looking at companies that are selling to the banks, we saw a huge, very quickly reprioritization in what the banks, the credit unions were looking at. And really it was into 3 things that they were interested in, which was first one was how are they deploying things, COVID type of financial resources, PPP, EIDL, because they were able to, give credit and debt products without having it in the balance sheet. The second being mortgage refinance in the US is a really, really top priority. There's a lack of healthcare workers in the US. There's also a lack of more people doing refinancing mortgages. So anything that's playing in that space is getting right in front of the banks. And the third, which is important for this group, is infrastructure. Right now, more than ever, things that are cloud-based are getting priority, because in the US, we saw people like TD Bank that went completely virtual and through their VPNs couldn't access data points on their customers like balances, account numbers. And then their entire network went down for 2 to 3 days because of the amount of people that were on it. So we're finally getting to see the testing of the market in terms of their critical infrastructure, where we're going to see things that were on-premise solutions go to the cloud faster than, the predictions of 2021 or 2022.
Okay. And Gustav managed to join us. Gustav, do you want to introduce yourself quickly and maybe answer the question? Gustav? He's just writing messages, right? I don't know. No sound. How do I do unmute? Unmute. So if you look at your screen, on the top right corner, there is mute and unmute.
Elena, you can unmute for him as well.
I try to see him. I don't know. I don't see him somehow. Where is he? Let me try. Ah, I know why. You joined through attendees link. Now I promoted you to panelist. Now you can speak, Gustav.
So much power.
Now you can hear me.
Gustav, please speak now.
Welcome.
Sorry about the speaker challenge, or perhaps I'm the challenge. Nice to meet you guys. Interesting to listen to you. I work at a company called Storebrand in Norway, Scandinavia. Probably you haven't heard of the company, but it's actually the largest asset manager in Norway, next to the oil fund in Norway. So I am the Chief Innovation Officer at Storebrand, and we are working a lot with partnering up with different fintechs and startups right now, because it's a very important tool in the innovation toolbox. And we also invest in a couple of them just to strengthen the partnership. So that's the reason why I'm interested in this panel. Really nice to meet you and to be part of this panel.
Okay, do you do any change of go-to-market strategy for your companies?
For the startups, you mean?
Or maybe you as a company as well, like what's changed? How do you adjust to the current situation?
Yeah, like 90% of the workforce work from home. I guess that's kind of a normal case worldwide. And we try to kind of mitigate the risks and have control of the risks, the financial risk. But during that process, we, from the beginning, started to focus on the opportunities during the crisis, and to also focus on the changing customer needs. So it's a lot of different needs that are changing right now. So we're trying to adjust the company to that.
Okay.
And also to help our partners, the startups that we are collaborating with. Some of them are in difficult situations, and we try to be on their side during this crisis to strengthen the relationship to them long term.
Great. Someone else has the idea?
I would add that, I guess with the current situation now, there's such an emphasis, all of us are looking at runway and looking at sort of figuring out which companies are in a strong cash position, as well as myself specifically, a more narrow product focus. So previously, I would look at companies that were either dominating a small market that was on the verge of being an extremely large market, and there just needed to be a tipping point. And within that, there was maybe 3 or 4 different things that were required from a product perspective. While we still are looking at some of those companies, a lot of the emphasis on where we invest now are companies that are already executing. So we've kind of started to invest a little bit later, sort of a little bit ahead of where the growth probably might have happened a year ago. So I think that's kind of sped things up, which is why there's a greater emphasis on cash, why there's a greater emphasis on the product roadmap being much more narrow, and then also a greater focus on repeat founders and sort of that senior leadership, because I think all the investors as well as companies are looking to mitigate risk. And in these times, the exciting thing is that these are usually when the top companies emerge, right? So if you are those rare companies that are able to sort of break through and endure and persevere, you go down in history with some of the legends that we saw in the previous period. So we've kind of now taken that level of focus, 12 to 18 months minimum on runway, as well as repeat founders with exit experience.
Maybe I could comment as well. So from our perspective, it's a bit awkward because essentially, for those who know what's an ICO, it's initial funding, which essentially enables you to sell your token, and the contributors get a token that they could use in your network, right? And we did that 2 years ago, a little bit more than 2 years ago, and we released different products and features, but our main product that we've been working for the last 2.5 years was about to be released in mid-March. So obviously we had planned 1,000 different things and you know, a lot of different events, and unfortunately for us, well, things didn't happen as we wanted. And from this, you know, Corona crisis or pandemic crisis, whatever you want to call it, takes that there's 2 ways to go: rather the defensive mode or the, you know, more aggressive mode. And it looks like a lot of crypto related type of companies haven't done this, you know, haven't been able to maybe go through this 2020 thing or to 2021. So for us, it was actually quite the opposite. So we went quite aggressive. We have enough funding. And I think so what's really good for us is that the first 2 months, we didn't have so much traction, which sucked. And we couldn't even do a high five between, you know, everyone and just, you know, open a bottle of champagne just to celebrate. So we really had that baby blues thing. But now it's really paying off the dividends. We're seeing like massive growth of 500, 700 people per day actually downloading our app, depositing our app, and going into premium. And our token has just went bananas. It went like 350% in the last 2 weeks. So last week. So it looks like our strategy was good to be very aggressive on this. Obviously, in the long run, we'll see how things go out. But yeah, with this crisis, we got some good momentum, and for hiring the best tech people, as you guys know, it's the hardest thing. Now it's easier, which is really good for us too. So we took some action there, and we've been able to to recruit a few guys that we've been, you know, really wishing forever, and now they're like, okay, let's go into in Swiss. So for us, it's been a little bit awkward in the beginning, and now it's I don't know, it looks like things are finally paying dividends, so we're very happy.
I would like to give my perspective about this crisis from another direction. What we have done in GVI, in Gold Ventures investment, we try to see what is the opportunities in this crisis. So not only what is the threats, what is the opportunities. So what we have done, we decide to team forces with a lot of ventures, with a lot of funds in Europe, in United States, in Asia market, together in order to see what is the new needs that we can identify or we can predict that the world should have. And based on that, what we try to do is to make some pivots to a lot of startups in order to deal with these new challenges that we have in the world, in the new world that we are going to be in. So what in the end of the day, the results of this process is that because we are team forces with a lot of venture capital, with a lot of investors from other countries, in this way, we built a global acceleration program in some countries in Europe, for example. And the global acceleration program is financed by the corporates and by the investors from a lot of countries. And in this way, we reduce the risk dramatically, and we bring a lot of public funds from Austria or from Poland, and we match it with private funds. So in this way, the startups can survive. They're not stuck because they get funds from public, from a lot of countries that support them, and we make a lot of POCs and pilots in order to help them to grow in a specific market that we see that there is specific needs. So I think that in any crisis, we need to look for opportunities. And this is what we have done in Gold Ventures.
Anyone else wants to share the ideas?
Maybe if I could chime in, I think it's very. We've addressed this in a systematic way where the initial is looking at cash preservation, and then the second step is finding that opportunity. And then third is actually going after how do we pivot that business model if needed. And I'm hearing a lot of investors or companies start pivot too quickly. You know, common example is going into digital health or telemedicine. The way the unit economics work in telemedicine right now is that telemedicine on its own is a very commoditized space, even before going into COVID. And so the rhetoric coming out of everywhere is, okay, let's do telemedicine. But what we have learned going into this and through this crisis is your capital efficiency matters quite a bit, and the VCs in the later stages. So we invest in later from Series B onwards, typically. If the unit economics are not working at that earlier on, we're not going to scale, right? And that's going to be even more clear cut after this crisis. And so a lot of the startups, I think, where their key KPIs were on growth, and now it will be more balanced at this point, right?
Thank you. So let's proceed with the second question. Did you rethink your portfolio company's priorities? What is more important for you? For example, cash flows or product advancement, sales, or anything else? And let's start with Adrian from Mendoza Ventures.
Well, it's funny because we've got global companies. Some of them had to actually, you know, as much as we wanted to prioritize on sales, like perfect example, one of our Canadian companies was focused on the US market. They can't come to the US market, the border's closed. And so that's one of the big things that had to get pushed out. And now more than ever, we have to focus on our global partners, whether it be other co-investors, whether it be LPs, whether it be channel sales opportunities for those that are in country, like in the US or in Europe, that actually can remain there and help them. So in that case, you know, I think someone said it really quickly that, you know, at the beginning, you just focus on cash flow. You know, once cash flow goes in, then you look at market opportunities. When market opportunities go in, you look at sales. So it really becomes this perfect triangle that everything has to be in balance. So for our companies, the first 2 weeks were, let's look at cash flow. And then out of that, several companies came up with very interesting market opportunities on the fintech side, whether it be focused on merchants, whether it be focused on writing some of the SBA sort of small business loans and tackling that. So it happened on a case-by-case basis. I think right now, we had already started seeing the trend of lower valuations. We'd started seeing the trend of, you know, I think someone also mentioned about more sort of cash versus growth. So I think it has to have the perfect balance, especially for the startups here, is you have to have the perfect balance of what is your COVID story. And your COVID story can't be you furloughed a bunch of people or everyone had wage cuts. Like what happened? Because everyone's going to have that same story. And so for the startups that are here, you have to have that story of what did you do different than everyone else?
Thank you. And Katya, what do you think about this? You are as well from New York Fund. How do you rethink the priorities for your portfolio companies?
Yeah, I agree with everything that Adrian mentioned on there. Oh, sorry, Katya, I thought you just mentioned Carta. So
no, go ahead.
But you can continue.
Carta
I know
I can go after you.
I'm fresh in the brain. I'll just quickly agree with what Adrian said,
Yeah,
and then I'll defer my time to Katya and effectively say that, you know, there certainly is that priority on making sure that the fundamentals are sound, more so in a way that maybe was a little bit more excusable when you were in a 10-year record bull market in the US. And also for us, that would mean just also doubling down on projects that are core infrastructure. We all recognize that cuts are going to get made in this environment as companies look to lean out. So how is it that you, as a startup, can make yourself indispensable? And a lot of that could be flexibility. I mean, nothing more flexible than automakers making masks, right, or ventilators, which is sort of outside their core. One of my fellow panelists, Jason, I believe from Volvo, can testify to this, the agility of some of these companies. But yeah, I'll defer to Katya. Apologies for that.
No, I think that was good. I agree with you guys. For us, what's important is to make sure that companies are in a sustainable cash position in a way, so they don't have that dependency from VC cash. So for us, it's important that they're cash flow positive and getting at least to break even. So we're looking more into those companies, understanding that we still don't know what will happen until the end of the year, and we need to make sure that the company have a very lean approach to cash management and overall budgeting, so they can live through even without the fundraising. So for us, it's important to look into the numbers now even more than ever. If before we could sort of forgive certain things and be okay with companies burning too much cash like for the sake of growth, but now we want to have that perfect balance to make sure that it's more like a smart way to grow. That's what is important for us.
Thank you. And Elisabeth from German fund Acton Capital, what do you think about this?
Yeah, I was just thinking that there is a non-logical side to it, at least in some European countries, with the government programs that have been installed for topping up follow-on financing rounds. Thinking about Austria, there's such a program. In Germany, there's such a program. And in some cases, I'm observing this creates the paradoxical situation that you don't have to think about cash as much as maybe it would be necessary in the current situation, just because the government is pumping money in. In some situations it can be very useful. In others, I'm not sure that it's the right policy approach.
Thank you. Quite interesting that government supports startups in Germany. And Jean from London, from Epis Partners, what is your opinion?
So I think, if you look at your revenues, you get the most bang for the buck at retention, and also with relative to products. We had companies where if you are in a market where it's exposed to credit, it's going to be pretty bad. And so it's a matter of repurposing your product to an end market that is with minimal effort, to an end market that that is less cyclical with minimal effort, or sticking with your existing customers to upsell, because new businesses will be tough. If you take a step back, there will be new opportunities coming out of this slightly medium term. So if you look at open banking in Europe or any other country, payments for if you look at open banking, the payments has been the big issue. And a lot of the non-financial institutions, such as like a travel agency or e-commerce company that has not been as linked up and open to this open banking APIs, they're looking to use the payment vector to get into getting better conversion with the customers. So that's a way for a company to pivot and expose themselves to certain segments that are more open at this point.
Thank you. Good point that companies should orient on their customers. Boris, what do you think about this?
Well, actually, an interesting question that I was running through my head as listening to the panelists is M&A, right? Like we're talking about like how to prioritize the business, and in our company, a question of M&A became much more relevant, because even in sometimes it became much more effective and efficient to launch a new product via an M&A. So we are now actually spending quite a lot of time exploring M&A opportunities. So I would be actually really keen to hear the other panelists on the opinion on the potential of an M&A. I'm sure everyone read like Revolut is looking to do something. Some other startups, especially in Fintech industry, are looking to do some M&A transactions. And somewhat compressed valuations because of the COVID is making this a very interesting development. So whether it's a portfolio company growing via the M&A, whether it's just a company growing in M&A. So for us, it's very relevant, and we are looking to a couple of those transactions, and I'm actually very keen to hear others' opinion about this.
Thank you. And Jason, what is your comment on this?
Yeah, just to address the initial comment, there's two sides to that coin. The first is M&A in this environment, I think, is great for the buyer, right? Because valuations are somewhat depressed. But for the seller, i.e. the investor like all of us, we may whipsaw ourselves a little bit in exploring those opportunities too quickly. I think we're going to be in kind of this range of valuation for another maybe year or two, but depending on the stage of development that you're investing in, earlier versus later, it might be worth it to maybe wait just a little bit to see if the proof points that you were seeking during the investment have been met or not, to avoid undervaluing an asset based on a market cycle. One of the things that we've been focusing on, just to kind of address some of the other comments as well, are two things for the companies in our portfolio. The first is pipeline optimization. So, firing some of the clients that are lower on the pipeline that may have been more aggressively being pursued, and really focusing on kind of the top of the funnel, so to speak. Closing the deals that are already on the table. So that's kind of helped the companies that we've invested in maintain their revenue position and kind of accelerate on some of the leads that they're trying to achieve. And then the other side, which is a little bit counterintuitive, is what I would call like operational upgrades, right? So if you can't go and raise, a new round, again, from our perspective, we invest at, Series A and kind of late seed. So this might not be as relevant for a later stage, but if you can't go and raise another round because of the market environment that we're in, how can you reorganize the resources that you have in-house to more efficiently serve the clients that you do have? Jen made a great point about retention being a very high lever in growth. We've been working with our investments and founders to really figure out, are there untapped resources and internal value that you can bring to the forefront? A great example is an insurtech company that we're working with that was lacking in just core, enterprise level project management capability. This downturn and work from home environment that we're all in actually allowed them to recognize that they, needed to double down or refocus on that, because once we do hit the next growth cycle, that's how they're going to be able to, achieve more with the enterprise clients that they're working with. And they were able to do it by simply taking a little bit off of the plate of their marketing team, a little bit off of the plate of the business development team, and really refocusing it on, pure project management. So those types of opportunities, especially with companies that are, you know, less than 50 employees, I think is a good way to unlock resources without having to go out and raise a huge round.
Thank you. And Gustav, can you share your thoughts?
Yes. First of all, perhaps I would like to clarify that from our perspective, we have two kinds of capital. First, we have the customer money or capital that we are managing. So that's the asset management side. So that's not the kind of capital I'm talking about in this panel. In this panel, I'm focusing on our corporate venture capital that we are investing in different startups. So I agree with previous speakers and Jason that it's interesting to see the different fintech companies right now, how they kind of refocusing, trying to earn money as fast as possible, not being forced to venture funds, trying to get into the companies at a very low level. So they are trying to focusing on earning money as fast as possible, and to stretch the time for the next round of venture capital. So that's kind of interesting. And also it's interesting to see how they are focusing on customer acquisition right now, because some of them can recruit customer at a lower cost because of people not buying AdWords and different kind of ads at the same amount as previous. So that can be a bit cheaper right now. And also how they are reprioritizing their products. So for some of our companies, focusing on down payment on consumer loans, that can be really interesting in times like this, because that can make end consumer saving a lot of money. So that's you can see a lot of different new needs and ways of working.
Thank you. And Cyrus, would you like to add anything?
I think so. I'm good here. Yeah, I said maybe what Boris was saying earlier. I think so. It is good time. The fact that I mean, we don't usually do any M&A or whatsoever. We haven't done anything so far, and I don't think so. We're really focusing on developing really our own products. But it's true that right now there's a lot of startups, especially in the crypto world, as I said, that are really financially negative territory. So there is really good deals. We are looking at different startups that have done great jobs, but they haven't monetized it yet, and are now looking for solutions to, rather merge or to sell. So we're looking at this. We're on a opportunistic level, and we'll hopefully, have something to do in the next quarter or so.
Thank you. Interesting to hear your focus. And Kobe, will you add anything?
No, Kobe has left.
Okay, anybody else, or we don't have time?
Maybe we can ask the next question. So the next question is like corporate VC versus financial VC. Like what COVID has surfaced having them in startups cap table. What's your view?
Well, I guess I'll start. Probably.
And then I want to hear the corporate guys.
Yeah, exactly. Yeah.
Jake said I definitely want to hear your background on this one, but I think we can rip off each other and see where it goes.
Yeah. You know, interesting thing, just as an aside, about, you know, just my personal background. So, you know, I was brought in to Volvo from the outside, you know, financial services, investment banking, VC world, because they did not want to have the stigma attached of a traditional, you know, corporate VC strategy first, you know, run and hide when the market changes, kind of a view. So, you know, I would say two things. So first, there are corporate VCs out there that have started to duck and hide in this environment. But I think it's changed a little bit from historical periods where we've had some market turmoil. Historically, corporate VC has been hasn't been seen as a major driver of innovation and, you know, revenue or shareholder value over the long term. It's been seen as a way to, you know, get early exposure to companies that could potentially be purchased, you know, over the long term. More recently, i.e. the last five years, really, CVCs have started to see the value, and I think Volvo is one of them. We start to see the value in corporate venture capital as a tool for innovation, i.e. getting access to very early stage companies, not for their potential growth, but for their technology, for their R&D capability, for their speed. So, you know, the approach that we've taken has been to take very small minority positions, but attach large corporate revenue opportunities to the transaction. So there's a commercial arrangement that potentially outstrips the investment that we've made in the company. So that way we've aligned ourselves with the growth and also gotten access to the technological capabilities that we're looking for. You know, what it does is it makes the corporate VC a little bit less of a hindrance or a tax on the company, because, you know, as I'm sure all of you have heard, sometimes if a CVC is on the cap table of a startup, investors get a little leery because they think, well, you're just going to sell to that corporate VC, or you're just going to sell to that company eventually. The way that we've discovered to get around that is, again, play a very small role in the capital structure, but play a very large role in the revenue generation for that company. So you get kind of a double effect on the investment. You know, it's worked it works when the company's founders and current investors understand the value of, you know, global scale. It doesn't work so much when the company and the investors think more in terms of, you know, dilution and, you know, current valuation, so to speak. So it's a much more long-term approach, but we've seen that it's starting to come around, especially in fintech, because a fintech company, I mean, it's very difficult to survive if you don't have some sort of large partner to help you move along. Especially if you're in a non-disruptive space. Crypto is not one of them. I mean, you know, you don't need a corporation to help you, you know, grow a brand new platform. But payments is an area that you definitely want to have, you know, larger corporate sponsorship, because I don't think there's going to be, this is just my opinion, I don't think that there will be huge amounts of disruption in that space without the help of large financial institutions.
Maybe if I could chime in, because we're kind of falling between, we manage corporate VCs and a lot of the strategics would outsource to us as a financial investor. And the rationale is actually, there's a few things. One, at a very earlier on a startup's stage, if you take in too big a strategic money, it limits your TAM, right? If you're at a seed company and a corporate VC or a strategic takes 30%, 25%, it limits your addressable market. And so our LP, in this case, a top 3 US life insurer, said, you guys move faster than us, and you guys act as a buffer, and you do the commercial side, and we'll work with you on the strategic aspect. And after 7-8 years, we facilitate the interaction with the corporate strategy team and the startup, but we're not actively, we're looking at this from commercial perspective, and our LP is looking at it from a strategic perspective. But like, it depends on where the stage of the company is really, because if you're towards the Series C onwards, it becomes okay. If you get involved too early, and I've seen our some of the bigger LPs where banks or insurers get involved, they move too slowly. The BUs get involved, and that cycle of adoption and implementation, if you're a startup burning cash 12 months, 18 months, you'll die in the POC stage, right? So you kind of have to balance that as a startup.
Yeah, from what we've looked on it, where we've partnered with Slack or Barclays Bank in some of our deals, and it has to make sense, especially at the early stage. One of the things that we've seen with the corporates that we work with is they started heavily into the investing in the early stage and then realized that it was like way too early for them. So now they're looking for like Series A or Series B where they can deploy more and make a larger impact. But very early on the startup side, if you have a really, really clear use case, you have a really clear reason of why Volvo is in there or Barclays Bank is in there, it makes sense as an investor, and especially on the VC side, why the relationship is there. One of the horror stories that we've seen is early stage startup or even Series A startup goes and gets 5 or 6 strategic investors, puts them on the board, and then there's an inability for the founder to make a decision because the corporate VCs don't have the ability to move fast, and they literally gridlock and deadlock the company and literally kill it. And so that's one of the things where we have to find the right balance of a right corporate VC that acts as a partner. The other thing that we've seen with some of the corporate VCs that they'll come in to invest to get early, allocation into the company, but that doesn't mean that you have a partnership in place. And that's really, really important is, yeah, you've got in some of the big guys, but are you actually having them as a customer? Because if they're on the cap table to be on the cap table and they're maybe making an introduction, but you don't have them as a direct partner or as a direct channel sale or as a direct customer, then to the startup, it really doesn't make sense for why you're there.
Yeah, it makes total sense. Along those lines, what we try to do is make sure that, number one, we don't take board seats, right? We don't want it. There's too many control factors that you just mentioned involved there. And we don't want to be seen as a hindrance to the startup, right? So we do take board observer seats so that we know what's going on with our investment, but we don't actively participate on the board itself. And then along the same lines, we don't take large positions. So we won't lead. We'll come in and look for guys like you, right, to lead, price the deal, and then we'll participate at the lower end of whatever deal that is to leave as much room for the financial partners as possible. Because quite honestly, strategic capital does not do a very good job of due diligence. So, financial VCs are much better at that than strategic capital. So, I think over time, we're going to see, and, Jen's platform is a perfect example of this. The hybrid approach is where it's going to end up, where some CVCs are doing more in-house traditional VC, and more traditional VCs are going to be doing more strategic type of investing. But I think that happy medium is going to have to be met, especially in certain markets where you need scale and you need it fast, right? And it's very expensive to advertise your way out there. So, if it's a pipeline approach, I think it works better. But if it's simply getting access to an early stage company, it typically wouldn't work, and you really should think about it.
Yeah, Jason, you're absolutely right. And Jen, I think your model is kind of definitely the future of corporate VC. We do a lot of work with Luge Capital in Toronto, and they're the corporate VC for a few of the banks. And it's a really, really good team because it's their VC first that happens to be the LPs. And that gives a little bit of flexibility from the corporate, because when we've done direct investments with corporates, they have compliance restrictions, whether it be voting or non-voting shares, or you called it right, you know, whether they have a board seat or not a board seat. And so you as the founder need to know a lot of this detail, because even for one of our companies, one of the banks, that corporate VC said, well, guys, we can't come in for, we have to come in for this exact amount. We can't own more than 10% of the company, because in the US, there's certain laws that rely on governance so that there isn't large corporations owning multiple companies. And so because of that, you as the founder need to now do the math, so that if you capitalize the company, well, then they have to own a certain part. If you under, then they can't sort of get as much cash as you thought that you were going to get from them.
Maybe if I just add one more to what Jason said, the alignment between the business units and the corporate VC is quite important, in that the BUs are looking for what makes impact next year for them, right? They want to buy the next shiny thing. Whereas the CVC is looking at strategically 4 or 5 years in advance, trying to transform the company. So there is, that has to be managed well. And it's, yeah, I mean, it's a delicate balance.
It really is. It really is. And, one of the ways, because I'm living this daily between BUs and the startups. One of the ways that I keep everyone aligned is I say, look, this is not an investment for pure capital return. This is outsourced R&D, right? And that R&D has to have a return, an ROI attached to it. So lo and behold, if the ROI is realized, then the startup wins, right? So it is a delicate balance. It's really a hard conversation at the CFO, in the CFO's office, right? Because he really does, from a corporate finance perspective, he really does need to meet his next quarterly number, and to lock up, $1 million or $500,000, quarter over quarter, and not really see the return on it. It makes it a harder conversation. But as soon as you start to see some exits as well as ROI at the BU level, it makes it a much easier conversation. But you do have to temper their shiny object mentality, because everyone loves working with startups. All of us love working with startups. That's why we do what we do, right? So, but inside of a corporation, you have to temper that, because there is a lot of cash that can just be tossed at it, and a lot of cash can be lost very quickly without a longer term view.
Thank you. And we have just 3 minutes left. So very briefly answer who would like to comment more. What is the most important lesson from COVID-19 for you?
Have a really good home office, because you'll be there a lot. And look, this isn't the first time or the last time that this is going to happen. So, for us, we saw that really early on. A lot of customers had problems, and just even sort of sales targets, just the idea of working from home and being remote. And you know what? For us, it's okay if a team is remote. I think our companies went remote, and you know what? That's okay as a founder, especially now, to be that you can continue remote.
And I want to add to this question, would you change something after this situation in your work? For example, you start working remotely and you don't come back to the office or something like this.
We haven't been to our office in about 3 months. I'm going to try to walk in on Thursday, I'll let everyone know how it goes.
Well, I think the main lesson is just don't panic for us generally. I mean, like, it's just another bump on the road. Some bumps are bigger, some bumps are smaller, but the world continues. I mean, I remember 2008, and I was working in banking, like in a large traditional bank, and people thought the world will end. Well, it didn't. Like now, again, people thought the world will end, and it didn't. So I'm sure everyone will have 3, 4, 5 bumps like that on their road, on their path. Just don't panic.
I think the
really quick, very quick, so that everyone can share. Thank you. Yes, sorry.
Yeah, just quickly, I think this decentralization trend is applicable for VCs too. I think the trend with decentralization is as you go towards building more resilience and fast decision making, you're seeing actually decentralization with decision making at our organization in the field offices. We have offices everywhere. And I think I've learned that actually not traveling, you can get 95% done without having to travel. And so I feel like I've wasted a lot of time just getting on planes, and it's just bad for the airlines, I guess. Yeah.
Do you think you will travel less after this?
Much less, much less.
That's great, actually. That's good for environment.
Maybe I have a little
anyway.
Maybe I have a little comment as well, is that I grew up in New York as a kid, and then San Francisco, and now I live in a village, Lausanne. It's a very small town in Switzerland, right? And everyone was making fun of me, like, usually you do the opposite. You're like born in a village and then you go to the big place, right? I think so this is gonna change a lot. I have a very nice view of the lake and the mountains, and my apartment is 2,400 francs, which is a lot because it's the most expensive country in the world. But I'm pretty sure that in New York and San Francisco for $2,400, you probably don't get that. And I really see that, like, a lot of our teams that are in the middle of nowhere, and they're like surfing in the morning and working very hard during the whole day, whatever their hours are, is that we're seeing a lot of people being able to work remotely distributed. We have 50% of our staff is always distributed on different places. And this trend is really, I think it's gonna grow. It doesn't make sense to pay $10,000 for an apartment in a city where you could actually, just move like 500 kilometers from that city and have that same apartment for maybe 1/3 of the price, or even 1/10 of the price. So I think that is probably gonna change, and I don't think we need to all live on each other. The world is quite a big place.
Okay, great, guys. Thank you very much. Sorry that not everyone was able to join, but we need to start the pitching part.